So once again, thanks for your time for joining me. I greatly appreciate it. We're going to walk through the coordinates outlook update call that I've put together for you guys today. And from this next screen here, you can see by the old school picture on the screen that we're going to be using classic video games as a metaphor to help describe our outlook for the remainder of this year. Remember that the question on the screen here is, are you ready? And this is very important, especially with where we're at today. Are we ready for the next level to level up to the complexities of the market moving forward? And are we ready to go ahead and think about some old school video games to walk through this examples for you today? When we think about video games, we think about them starting off easy. The challenges are less onerous, the speed is much slower, and the player is allowed to build confidence. But as you progress to each ensuing level, the difficulty ramps up, your reactions must be quicker, and your strategy has to be impeccable as you start to see tensions build. And that's exactly where we're at in the financial markets, because over the last few years, when we look back, level 1 and level 2 have been fairly easy to navigate. So congratulations, we've completed level 2. Now, what does that mean? Well, level 1 was all about recovering from COVID. And with the help of vaccines, unprecedented fiscal stimulus, supported Fed monetary policy, we saw spending on behalf of consumers, and the ultimate results were that we saw the shortest recession in the history of the United States, which only lasted 2 months. We also saw the shortest bear market, which ever really only lasted about 1 month. So in particular, that level was from the end of 2019 through the end of 2022. All of a sudden, risk started to mount and we entered level 2. And level 2 was a lot harder because we had a lot of naysayers that said that they were going to have elevated inflation, or it was going to stay higher forever, and the economy was going to go into a recession. Some people called for a deep recession. However, what happened during level 2 was the economy actually got stronger than people had expected. Inflation started to decelerate, and as inflation started to decelerate, we started to see the economy recover. We had 3 major equity indices here in the United States that were pretty much near highs, and that's because of corporate profits have ultimately gone to record levels. And there's been a very low impact from all the geopolitical risks that have been swirling around the world. Now, that level was from the beginning of 2023 to where we sit today. We've accomplished a lot, and here we are right now. As we're entering level 3, in level 3, as you would expect, the dangers and the risks are only increasing. There's a lot of questions out there whether or not the Fed will actually cut interest rates. Where's inflation going to go? Will we have a recession? Will this new risk out there as gasoline prices are starting to move higher? That's all in the context of evaluations, particularly in the equity market being at pretty elevated levels. And by the way, we have an election coming this November. We are going to go ahead and walk through today these 8 different topics that are going to range from talking about the economy to politics to the major asset classes of fixed income and equities. And then we're going to conclude with a trio of vintage video games that I believe really articulate what asset allocation is all about. When it comes to the economy reminds me of the video game Frogger. And the reason for that is that the US economy has, for the most part, been in survival mode and been able to avoid a lot of the obstacles in its way in defying a lot of people's expectations that we were possibly going to go into a recession. And if you think about it, there's been no shortage of obstacles in our way. I mean, when you think back to the US economy, what the US economy has been able to overcome, 500 basis points of Fed increasing interest rates, that's the most aggressive tightening cycle that we've seen in 40 years. We've been able to overcome borrowing costs. If you look at credit card rates, they're north of 20%. If you look at small business rates, their borrowing rates are north of 9%. And when you look at mortgage rates, they're close to 7%. And when you look at the housing market, we've seen some significant declines. If you look at activity within the housing market, it is now down 36% from its peak. We've been able to navigate through that as well. Some of the other things that we've had to navigate through is the fact that we haven't got any help from the global economy. When you look over in Europe, there are many countries that are still in a recession. And when you look, excuse me, sorry guys, and when you look at survey data, for example, you can see that how consumers feel about this economy. They still don't really feel that great about it. When you look at business surveys have not ultimately been that robust, but we've been able to overcome those bad feelings and continue to survive. And ultimately, we think this economy has been able to recover from all of these different obstacles and return to a safe place. Our new forecast is that we're actually going to be able to skirt a recession this year. Why is that? Why are we going to be able to skirt a recession? One of the main reasons is that the consumer, which represents 70% of the United States economy, continues to be in very good shape. When you look at these different factors, and we have a spectrum here that goes from recessionary conditions to very supportive, you'll continue to see that many things here are still very supportive of that consumer. For example, when you look at the consumer right now, we are at all-time record highs when it comes to net worth. Historically, consumer spending does not collapse when you have record wealth. Second is we still have a healthy job market. While it's not as robust as it was a year ago, what you see is that recently we saw the United States economy create over 300,000 jobs in the month of March. So we still have a healthy job market. When you look at wages after inflation, they've actually improved. So even after taking into account the increases in inflation, people actually have more money to spend. And when you look at the leverage, there's no doubt that delinquencies are picking up and a lot of people have stretched credit card balances. However, you have to put that into perspective and keep in mind that 60% of consumers do not carry any credit card debt, meaning they either pay off their credit cards every month or they don't own any credit cards. The point here is that the majority of Americans do not have that big burden when it comes to credit card balances. And then I think it's important to understand that there is some insulation that we as consumers have from higher rates. As an example, it's important to recognize that yes, mortgage rates have gone up 77%, but the reality is that 75% of homeowners have a mortgage rate of less than 4% or they own their home outright. So the uptick that we've seen doesn't necessarily mean that you and I have to pay more for our mortgages, but it does mean that it gives us less incentive to switch or buy another home. The other factors that are supportive of why we don't think we're going to see a recession this year is the employment market continues to be healthy. If you recall back to our last presentation in January, we thought during the middle of this year, we would see job growth turn negative. Well, our economists have updated their models, and right now they do not see job growth going negative during the middle part of this year, and that's significant because as we've always said, you need to have 1 million job losses at a minimum to actually go into a recession. Our economists believe that now we're going to get nowhere near that. We will definitely have a limited number of job losses this year, but the other thing that's important to recognize is that while we do expect the consumer to slow their spending a bit, particularly over the next couple of quarters, that will be offset by business spending that will continue to remain strong. And if you look at what's supporting business spending, you would see that we still have spending packages that have come from Washington, whether that's the CHIPS Act, the Inflation Reduction Act, the American Recovery Act. You can see business spending to bring back manufacturing here in the United States is still going to be strong. And by the way, that's not only domestic companies that are bringing their manufacturing to the United States. You're also seeing foreign companies such as Taiwan Semiconductor, which recently was announced they're going to build a facility here in the United States, as well as Samsung. And when it comes to AI boosts, there are a lot of companies spending money to continue to further the AI trend. Keep in mind that we're likely eventually going to see the defense bill spent that's going to provide support to Ukraine and Israel. And it's been noted in many reports that much of the money will be spent here in the United States, where the military needs are actually created here in the US. So the point is that even if we have some softness in the consumer, a lot of this softness will be offset by continued spending by businesses. As a result, when you look at our updated forecast by our economists, there's a very small change. They no longer expect a mild recession that they had anticipated earlier this year. What we are likely to see is something that we didn't think could be accomplished, which is likely going to be a soft landing. Now, this is going to be the softest of soft landings if they get it right, and that's represented in our updated forecast, where we have updated our growth forecast for all of 2024 from 1.7% to 2.1%. Now, turning to monetary policy, like Minecraft, the Fed has the ability to deliver that soft landing by nourishing the economy with a few interest rate cuts this year. Now, recently, you've seen in the news that inflation has started to tick up, but ultimately, we think that this is going to prove to be temporary. But that tick up in inflation has really caused the Fed to sit up in their seats and become much more focused on the data. The data is all about the economy, and the reason they are so focused is because we're at a point where traditionally the Fed starts to cut interest rates. In fact, if you look back at historical cutting cycles, they tend to occur about 7 months after the last rate hike by the Fed. And if you look back, the last rate hike by the Fed occurred in July. So we're now approaching 9 months, which means that we're a little bit beyond the historical assumptions with the Fed continuing to be on hold. Now, ultimately, we think that the Fed is going to cut interest rates this year for 2 reasons. First, I do think that inflation is going to continue to move in a downward path because I think that there's something wrong with the official statistics that come from the government. And what I mean by that is that I think that there's something different from the numbers they're providing us versus what we call our real-time indicators of actual transactions that are taking place in real time in the economy. As an example, if you look at rental prices, if you look at the official statistics, they would tell you that rental prices across the United States are up 6% over the last year. But if you look at the apartment list or rent.com or one of those, you would see the aggregate rental prices are actually down on average about 1% across the United States. If you look at vehicle sales and you look at the official statistics, you'll see that they're down about 1.4%. But if you look at Manheim, it does 5 million car auctions per year. They would tell you that the average price of used vehicles is actually down 15% year over year. And if you look at watches, official statistics say that they're down 1% over the last year. But if you look at Watch Charts Index, which looks at 25,000 models of watches, they suggest that prices are down about 7.4%. And the same can be said about food and wine. My point is, I think that these official statistics are lagged and do not represent what's actually happening in our economy today, which is represented by our real-time metrics. So as we go through the rest of this year, I think you're going to start to see some of the data flow into the official statistics, which will bring down that downward trend, if you will, of inflation. The other thing that's very important is when I look at the headlines that continue to come out, I continue to see headlines that to me suggest that we're still going to be in this disinflationary environment. As an example, keep in mind that Amazon just recently had, for the first time ever, one of their selling events during spring. Usually they're in July and later in the year. But the point is that Amazon has these events and then the competitors join in. And those selling events tend to have discounted prices that should keep prices going lower. If you're a fast food person, you may have noticed you're starting to see price wars when it comes to fast food restaurants. And if you look at electric vehicles, you continue to see those prices come down for both new and used cars when it comes to EVs. And by the way, China has a model that now comes in at less than $10,000. When you look globally, China is being accused by one of its local countries, Brazil, of actually dumping goods cheap into their economy. If they continue to do that, that should continue to bring prices down globally. When you listen to conference calls by businesses, you're starting to see the businesses talking about the fact that consumers are starting to balk at higher prices for goods. So when I take all of this into consideration, I think we're going to see this disinflationary environment, specifically when it comes to the things that you and I buy. The second reason I think that the Fed is going to cut rates this year is because I think the economy is going to have a soft patch during the middle part of this year, the quarter that we are in now, and the third quarter, where our economists believe that you're going to see the GDP come down slightly below 1%. The reason that's significant is because when the economy starts to slow, I think it's going to ramp up the tensions on the Fed to try and deliver something that has rarely been done here in the United States before, and that is to deliver a soft landing. So I do believe they will take out what I would call few insurance rate cuts to make sure this economy does not slip into a recession. Now, you're going to hear a lot of naysayers saying that the Fed cannot cut interest rates, but when you check those comments with the Fed's past actions, you'll see that many of these comments are just unfounded. For example, you may hear people say that the Fed can't cut because inflation is still above 2%. Well, keep in mind, and I've showed you this chart before, but in 8 of the last 9 times that the Fed cut interest rates, inflation was above 2%. Some people may say that the Fed can't cut because economic activity hasn't contracted. Well, again, GDP growth was still positive prior to the past 9 cutting cycles. You may also hear that the Fed can't cut because asset prices, like the equity market, are still soaring. Well, again, if you look back over the last 9 cutting cycles, the S&P 500 was up on average 6% in the 6 months leading up to that first cut. So my point is, don't necessarily look at these headlines that come out. Look at the data, and I think that the Fed will take the opportunity to try to stimulate this economy so we can avoid a recession this year. That's why when you look at our official forecast, we think you're going to see a cut this year. Now, will the Fed be easily predictable? I would say no, absolutely not, because it's important to recognize what's happening with the data. And back in June of 2022, I think it was pretty easy to predict that the Fed, what the Fed was going to do. They were going to raise rates. And this is a spectrum of doves, which is where the Fed is looking to cut, versus hawks. And I think it was pretty consistent that they wanted to raise interest rates because inflation at that time was 9%. So the Fed was on board that they had to raise rates to contain inflation. But today, as of April 2024, there's still a lot more disparity. You have some members that want to raise interest rates, and you have some that are looking now to start to cut rates. If you look at Chairman Jerome Powell, he's pretty close to neutral. But I think over the next couple months, he's going to start to shift to the left and start to look for a cut. He is the leader of the Fed, so he'll likely drag a few of the other members to the other side with him and once again initiate some cuts at the Fed level. That's why our official forecast is that we're going to start to see Fed cuts starting as soon as June, and before all of this year, we're likely to see 1 to 3 interest rate cuts by the Fed. Now, one question I get a lot from clients is that if the Fed starts to cut rates, my money market yields are going to fall from where they are today, which is north of 5%. And it is true that you're likely to see money market rates start to move lower as the Fed starts to cut rates. But let's put that in perspective. The Fed is going to cut rates very slowly, and if they cut rates 3 times, yes, you're likely to see lower interest rates for your money market accounts, but they're still probably going to be around 4.5% or so by the end of this year. And that's still relatively high, a high level versus what we've seen over the last several years. So my point is, I don't think you have to be in a rush to deploy your excess cash, because I still think 4.5% or so is still a reasonable amount to get on your cash investments. And you can be patient and put that money to work as opportunities present themselves. Now, turning to politics, we are essentially around 200 days away from the election, and already the candidates are hurling political barrels at each other like a fast-paced game of Donkey Kong. Now, you would think that the economy skirting a recession would be a positive for the incumbent, because for the incumbent, President Biden, because dating back over the last 100 years, the market has been a pretty good indicator of who is going to win the election. And it's a very simple metric. But if there's no recession in the 2 years leading up to the election, the incumbent wins. If there is a recession in the 2 years leading up to the election, the incumbent loses. And that has happened in every single election over the last 100 years. However, as we've discussed on previous webinars, there tends to be a major disconnect right now between the actual economic numbers and the perception of the economy. And what I mean by that is when President Trump was in office, 65% of the population thought that the economy was good. Only 38% of voters view the economy as good, even worse for President Biden, as right now, 59% of voters actually view this economy as bad. As a result of this metric, power could be diluted this time around, especially given if the economy continues to be the single biggest issue on voters' minds. The other indicator that has had a good performance indication of who's going to win the election has been the equity market. First of all, the good news is that historically, the equity market has tended to do very well during an election year. In fact, during the election year, which is the year we are in right now, the S&P 500 has been up on average about 10.3%. It's the second best year of the first 4 years of a presidential term, and it's been a positive 83%. It's been positive 83% of the time. So this year's trends tend to be good for the market, but in the 3 months leading up to the election, the equity market has predicted 20 out of the last 24 elections. And the simple metric has been this. If the S&P 500 is up in that 3-month window before the election, the incumbent wins. If it's lower, the challenger tends to win. So this is something that will clearly come into focus as we enter that 3-month window at the end of summer this year. Turning to the fixed income market, we use the game Miss Pac-Man to articulate our view because in the game, your goal with Miss Pac-Man is to consistently gobble up the pack stocks, whereas in the fixed income market, there is value in consistently scooping up the coupon payments of your bonds. The good news is that when you look at current yields, which are these dark black diamonds, they are well above the 15-year average that we've seen. More important, when you look at the higher quality sectors, they're closer to the top end of this range. You see the riskier parts of the market, like in high yield, specifically when you look at investment grade, and you look at the coupons that high investment grade corporate bonds are at. They're at their highest that we've seen since 2016, which is the greatest coupon payments that we've seen in 8 years. Now, because of this uptick in higher quality yields that we've seen and the potential for some softness in the economy, we don't see the need to take too much risk with our bond portfolios. And that's why we continue to favor investment grade bonds. And when you look at the default rates for investment grade bonds, you see that they are very low. In fact, it's very seldom, at the worst, it's about 1.5% chance that it occurs. In contrast, if you look at high yield bonds, you can see that sometimes default rates for the most speculative bonds soar to 30% or more when it comes to default. We think there's a very low probability, particularly in the investment grade space, because corporate America continues to improve the healthiness of its financial backdrop. As an example, we look at something called the interest rate coverage ratio. Basically, what the interest rate coverage ratio is, if you look at the profits that companies make, how many times can they pay their interest payments? And right now, in aggregate, if you look at investment grade bonds, if you take their profits, they can pay their interest payments 12 times over. That's much better than it was back in 1991, when they could only do that about 5 times the significance. That is when you look at the high yield, and high yield bonds have improved slightly at below 5 times. That is also below where investment grade bonds were back in 1991. So we want to continue to focus on higher quality parts of the bond market. Now, one thing to keep in mind is that when you receive a higher coupon payment, it ultimately increases the return potential of your bonds. But if the interest rates fall, which we believe they will from current levels, that will only enhance your capital appreciation potential of your bonds. But to do that, the bond market's going to have to avoid the ghost of the bond market. So for example, if there was no landing of the US economy, meaning that the US economy continued to grow at about 3% or so, that would probably cause rates to move higher. If you saw a resurgence in inflation, that would be a big negative for the bond market, as rates would move higher if the Fed decided to raise interest rates. If they decided not to cut interest rates, that would likely send rates higher as well. And if we saw a reduction in demand by either foreign buyers or retail investors, that would likely send interest rates higher. The good news is that none of these are in our base case scenario when it comes to the bond market. More importantly, we think that the bond market is going to benefit from the fruits of a weakening economy. And Fed policy, meaning we do think the economy is going to slow during the middle part of this year. And when the economy slows, interest rates tend to move lower. As I mentioned to you, I think that disinflationary trend can continue, and that will continue to drive interest rates lower. And we believe the Fed will embark upon a cutting cycle. If the Fed embarks upon a cutting cycle, then the demand will be up for those bonds. And so far, we haven't seen any of that yet. We do believe that as we look towards the end of this year, that the 10-year Treasury yield will fall from where it is today, somewhere around 4.3, 4.4%, down to 3.25% by the end of this year. Now, turning to the equity market. The equity market has been moving along like a supercharged Mario. The main reason for that is that there has been no bigger beneficiary of this stronger than expected economy than the equity market. In fact, when you look at our earnings forecast, we are upgrading our earnings forecast from $225 per share to $240 per share for the S&P 500. Of these 5 factors, the main driver of that is the fact that we still think the economy is going to be able to skirt a recession. And that helps lift our expectations for the earnings of the S&P 500. The other factors that are supportive is that tech continues to deliver, coming in much better than what people expect. We have resilient margins because companies are minding their cost structures and they're able to keep their profit levels consistent. And we're going to see a benefit because higher energy prices are going to help the energy sector. And that could actually lead to an upside to even this $240 number. So we have even better earnings when it comes to the multiple that we think is appropriate for the S&P 500. We're not changing that. We still think that 21.5 times earnings is the appropriate and reasonable price to earnings multiple for the S&P 500. It's also important to refresh everyone that if you take away the peak that we saw in valuations during the year, we've upgraded our target for the S&P 500 to 5,200. Now, if you're watching the equity market that's not too far from where we are today, but like Mario in the game, oftentimes Mario goes backwards before he ultimately goes forward. And given the rally that we've seen, we think we're in a period where we're going to see pullbacks. And by the way, pullbacks are normal for the equity market. We tend to get 3 to 4, 5% or more pullbacks in a given year. And dating back to 1980, the average decline from peak to trough at some point during the year for the S&P 500 has been about 13%. So it's completely normal to see a pullback in the market. It's part of the fabric, if you will, of the equity market. Now, why do you think we're going to see a pullback in the market? Now, I think we'll see a pullback in the market in not too distant future. We've already kind of seen it in the last couple of weeks, depending on how you want to view it. First of all, I think that there's a big reason currently we haven't had a big pullback in basically 6 months. And historically, we tend to get a 5% or more pullback every 3 months. So we're double the time period without seeing pullbacks. Some of the other factors why we think we're going to see a pullback are, number one, valuations are elevated right now, which means that there's a lot of optimism built into the market, which means that the market is vulnerable to disappointments and could see a sell-off from the technical perspective. This rally that we have had has taken the S&P 500 and other markets up substantially, and oftentimes when you look back, you tend to need a cooling off period or a digestive period to allow the market to digest the gains that were received from a seasonal perspective. Keep in mind that April and May during a presidential election year tend to be more volatile. And if you look at equity ownership for retail investors, it has gone up to nearly 70%, which starts to beg the question, if you're already up to those elevated levels, how much more can you continue to buy? And then if you look at sentiment from another perspective, there's a question that's asked consumers in the Consumer Confidence Survey. And the question is, do you think equities are going to move higher over the next year? And right now that is approaching 50%. In fact, it's the second highest level that we've seen in history. And what we've done is we've gone back and looked at when that number has gotten above 45%. When that number has gone above 45% historically, you look out over the next 1, 3, 6, and 12-month time periods, the market has been essentially flat and range bound. So we do expect a much more choppy market, at least here in the near term. Now, if we do get a pullback, that does not deter our long-term positive stance on the equity market, because I do believe that from today, looking out another year now, or 2 years from now, we do believe that the equity market is going to move higher. Part of that is because bull markets on average tend to last about 5.5 years. Currently, we're only about 1.5 years into this bull market. From a magnitude perspective, we're kind of experiencing somewhat of an average bull market so far on average. At this juncture in the bull market, we're up on average about 50%, and probably somewhere around 40. Average, we're up around 50%, but today we're up somewhere around 47%. So we're very close to that historical average. I think that the long-term dynamics are in place to keep this bull market intact. And one of the big drivers of that is the fact that we still see positive economic growth still going into this year. This economy likely discarded recession and likely to see growth accelerate at the end of this year as we go into next year. With that, earnings should continue to move higher. In addition, keep in mind there is still a record amount of cash sitting on the sidelines. If you look at money market accounts right now, there are over 6 trillion sitting in money market accounts. And if we have a pullback, I think that some of that money could come off the sidelines and help support this equity market to continue the bull market. Turning to international markets. The United States has been the leader in the form of the greatest number of developers for video games. We have almost 7,000 developers here in the United States. Plus, when you look at the top 10 video game franchises in the world, 5 of them reside here in the United States. So just like the US has dominated in the video game space, we expect the United States to dominate within the equity space. Some of the reasons we expect that to occur are really fundamentals. And when you look at economic growth, the United States is not only expected to have superior growth this year from an economic perspective, by the way, doubling its next closest competitor, but when you look at the revisions, which are these dots, the US has seen a consistent upward revision of our economic growth prospects this year, where the rest of the developed world has seen their forecast revised lower because of those better growth prospects. Earnings have remained steadier. If you look over the last year, US earnings have been revised down slightly, but if you look at the revisions to the downside for the rest of the world, it pales in comparison to the revisions you've seen in places like Europe and Japan. And when you look at the sectors that we favor, you get the largest amount of exposure to tech, healthcare, and industrials here in the United States. Turning to oil prices, the name of the game for oil prices is going to be ping pong. Over the last year, for the most part, oil prices have been in the range of somewhere between $70 and $90 a barrel. That could mean that at this $70 level, it comes down to supply and demand. And when you look at the supply, if the United States continued to increase its production, which is already at record levels, and if you saw cracks in the OPEC agreement where companies started to violate their quotas, that could increase the supply of oil, and that could drive prices lower if for some reason growth in the US and other parts of the world continue to disappoint. That would reduce the demand. And if that occurred, you'd see stockpiles start to increase, and that would drive down the price of oil. On the upside, towards $90 per barrel, that could occur if you continue to see OPEC abide by their quotas, which would continue to limit supply from the demand side. The summer driving season is close to being here, and that could increase the demand for oil. We still need to refill the strategic petroleum reserve here in the US because it's still at some of its lowest levels that we've seen since the early 1980s. And then we still have these ongoing geopolitical event risks, particularly over in the Middle East, that could potentially disrupt supply. So when you look at these two sets of factors, we tend to lean to the upper end of the range. That's why our forecast is that the price of oil is going to lean more towards these factors and get up around to $85 or at least stay around $85 for the next 12 months or so. Now, when it comes to the energy sector, we still like energy with the second best performing sector, as you can see here, year to date. And if you think back to our 10 times energy, if you think back, 10 times energy was one of the biggest contrarian plays for the year. And the reason for that is that we do a lot of survey data. And at the end of last year, very few people actually liked the energy sector. It was one of the least loved sectors. However, in some of our most recent survey data, it has gone from one of the least loved to now in the top 3 or 4 sectors, liked by our investors. The point is that from a contrarian perspective, energies, I'm less enthusiastic about it from that perspective. However, our equity team continues to like the energy sector because of the fundamentals. And with oil prices remaining elevated around $85 per barrel, that makes these companies quite profitable. In fact, at $85, you're well above the current break even for the new well. The break even for a new well is about $55 per barrel. And for older wells, it's somewhere around $40 to $45 per barrel. So there's still a lot of profitability when oil stays at these elevated levels. And when it comes to valuations, we should point out that last year's energy was a big underperformer. So from a valuations perspective, they're still one of the most attractive sectors because of all the profitability and cash flow from that energy sector. It has the highest combined dividend and buyback yield. So the amount of money being returned back to investors is the highest. That's positive for you guys. And because of that cash flow energy, companies are taking advantage of that and reducing their debt burdens, which is making them ultimately healthier companies for the future. So because of these reasons, our equity team still does like and favor the energy sector. For our final topic, it's asset allocation. And for asset allocation, we bring to the forefront here a trio of classic video games. The first video game is the midday arcade racing games that you see in the arcade. And if you think back to those games, when you get into play, you have 2 choices to make. What course do you want to ride on, and what vehicle do you want? When it comes to picking your course, you can pick a course that has a lot of long straightaways where the curves are very muted, or you can pick some more challenging where there's more twists and turns along the way. But when it comes to your portfolio and your risk profile, you can choose a more conservative portfolio where there's not as many twists and turns, or you can have a much more aggressive portfolio that has many twists and turns along the way. As you can see, if you have more twists and turns, the ultimate difference here is going to be you're going to have more volatility. Obviously, the straighter the course, the less volatility that you have. With the greater the volatility, the greater potential of return when it comes to the equity market. The second video game that we have here is the second one here is just going to be to pick your car, pick your vehicle. When you get in, you have to decide what type of vehicle do you want. Do you want more comfort and durability, or you're going to pick more of an SUV? Or do you want something that's got more speed and performance, so you pick a race car? When it comes to developing your portfolio, you have similar decisions to make. You have to determine what type of potential return you're looking for to achieve all of your goals and objectives that we've outlined in your financial plan for the long run. You have to decide when you look at your goals and objectives, are some of them shorter term or are they longer term? And when it comes to comfort, you have to figure out what type of volatility you're comfortable with on an annual basis. Also, what type of drawdown would you be willing to take on a given year? And when it comes to the management style of your portfolio, you have to decide if it's going to be more passive investments, active investments, or a combination of them. The second video game I think that gives us a good lesson when it comes to asset allocation is Tetris. And when it comes to Tetris, it's all about fitting the pieces of the puzzle together. When it comes to asset allocation, you have to fit the pieces of your portfolio together in a way that maximizes the risk-adjusted performance of your portfolio. And remember that asset allocation is representative of determining 91% of the performance of your portfolio. The other lesson that can be determined from Tetris is that you cannot panic, because as these pieces start to fall, if you start to panic, you may not be able to fit them in as much of a fruitful way. And oftentimes, all of a sudden, it'll happen very quickly, and before you know it, you're panicking and the game is over. That lesson is very similar to asset allocation. You cannot panic when it comes to asset allocation, especially in the equity markets. As an example, there's a study that's been done by Dalbar. And if you look over the past 30 years, the S&P 500 has been up 9.7% on average. The average equity investor, as you can see here, was only up 6.8%. That's almost a 3% difference, because people oftentimes make bad decisions when it comes to their portfolios, meaning in the equity space. They oftentimes sell out at lows because of the panic, and they don't get the benefit of seeing the rebound. The other thing that tends to happen is that some investors tend to follow the hot dog investment, whatever is fancy that year, and oftentimes they get in at the wrong time when they are expensive. Now, some people would say that a 3% difference isn't that big of a difference when you look at it from a percentage perspective. So let's look at it from a dollar perspective. If you had a $100,000 investment 30 years ago, if you would have invested it in the S&P 500, your $100,000 investment would have grown to almost 1.6 million, as you can see here. However, the average equity investor earning only 6.8% would have only earned half the value of the S&P 500, about 721,000. So this shows you the performance and how much performance can be impacted by the power of compounding and keeping your strategy long term. Remember, we build investment portfolios to defend against inflation and taxes. We do financial planning so that way we have a strategy in place for you. And we do that planning so that way you have a plan that allows you to accomplish all of the goals that we've outlined and still be able to maintain during periods of volatility. The third game that we choose is the Madden NFL football series. And if you're familiar with the Madden football game, you actually get to build your team with the best players in all the teams. You get to build an all-professional team for yourself. And when it comes to investing, the goal between you and I is really to get an all-star team of managers and investment vehicles to manage each slice of your asset allocation. So whether we choose an ETF, a separately managed account, structured product, a hedge fund, a private equity, or a mutual fund, between you and I, we want to get the best investment vehicle for each of those different slices of pie. It's a very important exercise because there's a lot of dispersion. And as an example, if you look at the performance of mutual funds, and what we've done here is looked at the top largest 100 mutual funds for each asset class, we looked at the performance of returns just in 2023. And what you see is that, for example, in this small cap space for last year, you had some small cap managers that were down 10%. You can see that right here. You had some that were up 45%. You can see that right here. That's a 55% differential between the worst and the best money managers. The goal of our relationship is try to make sure that you get the best money managers and you get the best investment vehicles at the upper end of this range so that you can have the best performance and maximize the chances of accomplishing all of your goals and objectives. And with that, guys, I'm going to go through our disclosure slides for you here. We have 3 disclosure slides for you. And I want to thank you for joining me this afternoon. If you have questions, please don't hesitate to reach out. Happy to be a resource to you guys. And I look forward to seeing you at our next quarterly town hall, which will occur in about 3 months or so. Thanks so much for your time. Appreciate it. Take care and have a wonderful evening.